Nifty is absolutely flat at this point of time, 2 points down, 9,124. But let's just pull up the stock of Avenue Supermarkets. It's, of course, the new listing. It's the listing of the D-Mart IPO, or the retail brand D-Mart, which is owned by a well-known investor, Radhakishan Damani. 300 points higher, 598, a full 100% higher at this point of time. That's 299 rupees higher than what they have given the price. So that's a full 100 rupees, 100% higher, 597 right now. It's in and around the opening price. Not much has changed since then. Let's get in a perspective on this particular IPO. Deven Choksey is now joining us on the phone line. Deven, did you like this particular issue, Avenue Supermarkets, and you're not surprised by the 100% pop that we are seeing on the first day?
Well, Pankaj, I think we have put in a subscribe to this particular company, and we have been liking this particular company, largely from the fact that they have built the business, I think, from ground up level in a very systematic manner. The thin margin business in the retail, I think, assumes higher profitability only when you have a supply chain management at the back, and on the other side, you have a higher amount of volume taking place. I think which is what this company has wonderfully articulated in their business model. 60% plus, I think, revenue comes out of the necessity product, which is food and grain, which is giving you the confidence that going forward, the company will probably have the repeated customers coming in and consuming the products. So certainly, I think we have been liking the business model of the company. It is basically moving in the direction of, I think, some of the large global marts, I think, the retail companies, which have been following this kind of a bulk model. So I think we like this particular thing from that perspective. However, the valuation-wise, if you look at it, even though it assumes a 25-30% CAGR growth in the progress of the company eventually, I still feel that I think the valuation-wise, the stock is slightly expensive currently. Though I think one can always say that in such kind of environment, when you don't have too many competing products available in the marketplace, some amount of premium valuation is justified, and which I also like to buy that argument. But the fact is that I think for investors to buy into, maybe I think some time correction or the price correction, whichever comes their way, I think they should use it to buy the stock for the long-term investment.
Right. But, as far as the IPO is concerned or the listing is concerned, there is always valuations which become very expensive, at least in the first few months, because of people reluctant to sell or the scarcity in the liquidity for the company.
True, absolutely. And I think we have seen time and again in past also. I think Indigo was a classic example, I think, where we saw the same approach. Of course, Indigo didn't deliver the profit performance, I think, as much as it was expected. That's a different issue. But the fact is that I think sometimes the companies, when they get used to the euphoric mode after listing, I think at times they miss the sustainability of the pricing front. Hopefully this particular company won't, because I think they are probably done with a very careful approach on building the growth on a systematic basis. So one could easily expect the growth coming in also from the fact that the IPO money is going to retire part of debt. And obviously that would help in putting a higher amount of bottom line performance, because the interest cost saving would take place and along with the organic growth taking place. So I think this company could possibly deliver sustainable profit performance going forward.
Right. Going into this IPO at 600 rupees, chances of making returns will become very back-ended, or returns would come very delayed?
Yes, I think if you are buying something at premium, be sure that I think you are holding it for a longer period of time. If you are not holding it for a longer period of time, certainly I think the premium valuation would hurt you otherwise. I think that part of the understanding has to be clear with the investors.
Right. Names like V-Mart, Future Retail are all going down today. You think they were only going up because of this particular listing, but now people have option to buy this. So rather than paying a premium for those particular companies, one would want to invest into this straight away?
I would not subscribe to that theory, because I think most of the retail companies have been listed and they have not been able to build the business model which I think this company has shown. I think a typical character of this business model is that they have been running the business on high volume businesses, sweating their assets maximum, and at the same time supply chain management in the back to support them to procure the goods at a lower rate. I think all in all put together, they are delivering the profit performance, which is not the case with other retail companies. So unless I think they change and probably produce or bring the focus on the profit performance, I wouldn't I wouldn't buy into a Me Too approach and probably buy into the other stock. So even though they may be trading little cheap compared to this one.
Right. Then how does one pick if one had to in the real estate space? Given the premium of its listing, there may be a little reluctance to buy. Do you think there are other stars in this space that investors can consider?
I think you feel that this company is already showing a good amount of promise for the growth. So certainly, I think stay with that particular growth program that this company has demonstrated. If other companies within the space in the retail, if they end up producing a similar kind of a growth, I think one can look at them as well. I think because the sector as a whole, I think is going to grow significantly. And with the e-commerce coming into it, probably you would see a larger amount of growth possible for this company. Particularly the B2B e-commerce, I think, is extremely profitable growth into the retail space. So somewhere I think one will have to draw a line in finding out, I think, where exactly the company produces maximum amount of performance. And that's where you should be looking into for buying purpose.
Right. When it comes to their OPEX, many retail companies have had a difficult time. How do you think D-Mart stands out here?
I think count by count, if you look at, I think the purchase cost, I think, is on the lower side because of the larger volume that they have. So on one side, they secure their purchases at a lower price. They pay on upfront basis, so they get the cash discount for making an upfront payment. So once again, I think that's positive. They own their stores, so obviously, I think their outgo on the store is relatively less. So I think it's a capital-intensive model. Still, the outgo on the store would be less, which also means that they are also sweating their assets maximum, because the floor space that they have, which is basically maximum utilized in this kind of a situation. On the other side, you are having a format of food and grains, which is basically daily consumption item for most of the institutional buyers also, including the catering businesses or the hoteling businesses. So obviously, you are basically attracting such kind of large volume buyers who are basically taking up on a larger volume. So all in all put together, if you look at it, I think the company has carved out a business model which is very smartly articulated at the same time. And that's where I believe that since they're managing the cost well, their logistics well, and they are managing their volume well, that's where I think you have got advantage of both the sides. On one side, you are having a larger business sales. On the other side, I think lower cost, ultimately resulting in the better profits and the margins for the company.
All right. Thank you so much for joining us, Deven, giving us your views on the new listing of the day.